welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today's guest is a practicing gastroenterologist, an author, a big-time real estate investor, and the co-founder of PassiveAdvantage.com. Now, mark my words, you guys are going to want to check this website out, PassiveAdvantage.com. There are some resources on there that you hear me refer to as the easy button. So go check that out. Today's guest, please welcome Mr. Sam Giordano. All right, so here we are today, Sam, in this wonderful world of investing as a physician. In the last year, I've seen a lot of movement, a lot of trends, not only for myself in the single family world, but in the world of money and lending, the world of insurance. Like there's so many things that are changing right now, and it's always going to be something, right, Sam? Where are we at? But first, before we even get there, let's tell us a little bit about you, man, about medicine. Like I'm so excited to jump right into real estate, but just let the listeners know a little bit about you and your medical career, where you started and where you're at now.
Sure. No, I appreciate it. Thanks so much for having me on, Brett, and I really appreciate the time. So I'm a gastroenterologist, a practicing gastroenterologist in New Jersey. It's crazy to say, but I'm going on my 12th year practicing now, so time flies when you're having fun. But I would say my wife and I are both physicians, and so living in a state like New Jersey, obviously it's one of the higher tax states in the country. So as my income started ramping up, I started becoming more cognizant of obviously, both of us are W-2 employees, so we don't have a lot of flexibility from a tax standpoint as to how things can be sort of creatively altered. So I was looking for vehicles outside of my W-2 income that we could, improve our financial standing, maybe increase some passive income, as well as get us a little closer to financial independence, which, as I started out early on in my career, I kind of was, following like White Coat Investor, Physician on Fire. These are like, hallmark physician finance blogs. And I did all the basic stuff that they talked us about, like maxing out our 401ks, paying off our student loans, saving up some money, live like a resident for a few years. And these are things that now I teach to residents in the hospital that I work at. So those are like the basic tenors that it's not very complicated to do, but once you kind of get a plan in place and automate things, then, 5-6 years out of practice, you can kind of set yourself up where you're on a path and things are pretty much on autopilot. You're kind of investing every pay period. And then there came a point where I wanted to get a little bit more creative, getting back to like something that's tax advantage. And that's when I started to kind of delve into real estate a little bit. I thought I looked at initially stuff like you're talking about, single family homes in the area and maybe some turnkey rentals, and even looking at like quadplexes, like different opportunities that I could maybe be a little more active in. And I just felt like, time and time again, it just didn't seem like a fit for me. And I came across real estate syndications, and that's sort of been the niche that I've focused on over the last, 6 years or so, passive investing into real estate syndications.
So into multifamily, and I noticed that when you did speak of single family, it was kind of like in the area. Did you ever consider single families outside of your area?
I did. I mean, I talked to a couple turnkey operators because, not that you can't make money in New Jersey, but it's just not like the most, desirable and landlord friendly state and things like that. So most of the places I was looking at was in the Midwest or outside of the state. So I started to dabble with some turnkey operators. And then I had a couple buddies that looked into that as well. And we were all kind of simultaneously looking into those things. And we heard one or two stories about some horror stories, some property management companies that weren't so honest about some of the repairs, and then some issues that they were having that where they weren't on property when they were staying on property, and it was just it started to become where it felt like it was going to be a little bit more of a job. I really didn't know how to vet these turnkey operators in ways that would make that risk profile a little less. And so getting that start in that space when there was some of these horror stories that I heard about, after a while, I was like, maybe this isn't the right fit for me because I'm still a full-time physician. I don't have, time to be managing things too actively all of the time. So it wasn't too long that I kind of veered off into some of the more passive investing options.
And that's leading us into where we're at now in the kind of like the commercial side of things. In the passive world, did you start in multifamily, or were there other types of asset classes that you were looking at there?
Yeah. So initially, I probably, I think all physicians have this sort of OCD component. I'm sure there's other specialties and fields that have the same kind of thing, but I try to be really detail oriented and try to kind of think about things ahead of time and in many instances in all sort of aspects of life. So because of the fact that in some of these private placements, the investment minimums were so high, I probably spent the first year just kind of educating myself and learning the nuances, learning what to look at it as a limited partner in these passive investments, learning what questions to ask. And I read every book I could get my hand on, listened to a bunch of podcasts, um, talk to different sponsors, talk to other limited partners. And I tabulated all this information in basically like a sheet type of thing that would allow me to kind of vet some of these syndication deals. So to answer your question, the first type of asset class that I catered that sheet towards was the multifamily investment. So initially I invested in a fund that had several different multifamily investments because I really trusted the operator. And and to this day, I still base everything, a large percentage of my investment decisions based on that operator and a number of the variables associated with it. To this day, now I've also added, some self-storage, a mobile home, and a couple more esoteric ATM machines. So now I've invested in a lot of other asset classes, but I would say probably 60% of my portfolio, maybe 65% is in multifamily, and maybe the first two or three of those deals that I now have about 20 deals was in multifamily initially.
And a couple of things there. You mentioned a sheet, and the other thing was a fund and LP. And I'm thinking, as a W-2 income generator, how did the fund and the LP help you shield your income? I mean, were there any types of depreciation to offset that active income at all, or are you just offsetting the income you were making on the investment itself?
Yeah, so that's a great question. So the funds function similar to it, although now my preference is still single asset deals, but there's some components like in mobile home parks, since the parks are so small and they're not like a ton of money per park. When I say that, I mean like $1 million. So it's more conducive to like a fund as opposed to some of these other type of where you can have a 400 unit multifamily property that may be $60 million by itself. So in this particular multifamily fund, it did pass on all the depreciation to the limited partners. So if I made, say, a $50,000 or $100,000 investment, let's just say 100,000 for ease of numbers, that first year, I think I got like 75% depreciation up front. So a $75,000 loss up front. So then basically all the cash flow I received for a number of the years of the fund is basically shielded. And then any of that leftover depreciation, if there was a sale at some point in time, then I would use that leftover depreciation to offset that sale of that property. But interestingly enough, you can also offset the sale of another property. So say I had another syndication that gave me depreciation and then sold, but the depreciation that second syndication gave me didn't offset all of the sale of that. Then I could use the bent up depreciation of that fund to then offset a separate syndication. So you can get creative with it. And so nowadays, strategically, when I'm getting a heads up or I know that one of my deals is going to sell, if I don't have enough bent up depreciation, then I search out a deal that I can get depreciation to offset that income that's coming from that sale of of one of the old properties.
And I do see MD at the end of your name. I do not see CPA. So I just want to put that out there too, right?
That's right. I'm not a CPA.
All
This is
right.
not tax advice. I appreciate the disclaimer. I was going to give that if you didn't give that, but this is just what I do. So, you obviously speak to your own CPA and your financial advisor, make sure it works for you. So
Yeah,
it basically, it doesn't shield my W-2 income, but
right.
it shields if you can creatively work it in ways that shields any of the income that comes from the properties, that it doesn't increase your taxable income, at least not immediately.
And
Unless you,
when you say
uh,
pent up, you're talking like deferring the appreciation out. So if I have more losses than what I need, I can basically just kick the can down the road in a good way.
that's right. Yep. And you can just keep building up the losses. And then until eventually one of those properties sell, then you can use that to offset that property at that time, even if it's not the same property.
Hmm.
So that's the interesting part about it, because I wasn't looking to increase any of my taxable income. It was
Yeah.
really about, and then any of these proceeds from these deals, the way that I proceed is that thankfully, I don't have to use that for my day-to-day life because I have a day job. So all those proceeds I reinvest in new deals. So we have one of these calculators where it looks at the path to financial independence. If you invest, say, 100,000 a year, and you assume an 8% return, which, in some of the deals, it may, like right now, it may not be appropriate, but on average, if you say that conservatively, then and your target is maybe 10,000 a month passive income. If you invest 100,000 a year with an average 8% return and you keep putting it into these syndications, you could probably reach that point somewhere between 7 and 8 years. So when I saw that number, and if that's somebody's expenses, that's pretty powerful in a short period of time like that. Not that 100,000 is not an insignificant amount of money, but that you could then use that to kind of create this passive income stream outside of your typical day job.
What I love about that, sorry, Sam, what I love about that is in these situations where you're giving your experience and not your you're not giving your financial, you're not a CPA, you're not an attorney, so you're not giving a professional opinion here. You're expressing, your experience and what's worked for you. And I love that too. I mean, when I get into these situations, I was on uh, a call with a physician the other day, and they had lent money on a deal that went bad. And I just preface everything with, I'm not a CPA, I'm not an attorney. If I were you and I was in the same situation,
Yeah,
this is what I would look to
this
be
is what I
doing.
would do.
Yeah,
Yeah.
this is just a good thing. And that's speaking through experience. I mean, for me, it prefaces everything in the results, right? That, hey, this is what I've done. And I love approaching that way. And I guess, it's bad that we have to say these disclaimers and disclosures for
Yeah,
the people who go out and make these poor mistakes and their poor decisions and then blame other people for things.
that's right. That's right. Yeah, and it's true in the fact that there's everyone's got nuanced situations. There's different regulations depending on, different states, and whether you need to file a K-1 or not file a K-1. So I try to speak in general terms, but you're right. It's a shame we have to make those disclaimers, but I think we try to speak in somewhat generalities that can be applied to more people. But yeah, it's a crazy time right now to invest, that even as whether it's a general partner or limited partner, and that um with the recent interest rate rising, and the some of the people that are falling into hard times, in particular in the multifamily space, with these bridge loans coming up on being due, and interest rate caps that are expiring and things like that. I do think we're going to see a little more distress over the next 6 to 12 months, and then I'm hoping that soon, at that point in time, depending on the interest rate trajectory, that there'll be some good buying opportunities. But for me, I've up until this last year, I did mostly, multifamily, self-storage, mobile home. This last year, I've done a little more non-correlated investments, like I said, some of the ATM stuff and things like that, where the upside's not there. It's more of a cash flow type of a play, where you're putting your money to work, but you're not really getting that bang at the end. Um, but yeah, it should be an interesting time. But I think you need to kind of focus right now. At least what I'm doing is focusing on education, making sure that I'm getting ready for the opportunity, holding on to some cash, or if you can get 5% in a bank right now, or a high interest money market at Fidelity and Schwab and Vanguard and stuff like that. So it's hard to justify putting your money into a deal that where you don't know, there's some sort of precariousness to the interest rate environment, and you're only getting 4 to 5% cash flow on those deals. So sponsors are having a hard time raising money, understandably, because people see that. So it should be interesting over the next, like I said, 6 to 12 months. But I do think there's going to be a really great opportunity probably in the next year or so. That if you're ready, that it can kind of change the trajectory of your financial future a little bit.
Well, wow, you laid in so many things there, and I was going to ask you, what's happening in multifamily, what's happening in the syndication stuff now, and you really laid it out there in that, I mean, 2 minutes maybe. But the biggest things that I picked out on there, and I've heard several times before, Sam, are the bridge loans coming due,
Yeah.
the interest rate caps turning loose. And another thing I want to mention in there is the rise of insurance as well too. I'm sure that you're experiencing that, right? I mean, the insurance costs are skyrocketing.
It's unbelievable. Yeah, especially, I mean, I try to keep tabs on all this market information, and I've always invested in a large percentage of my investments, in particular in multifamily in the Sun Belt markets, the Phoenixes, the Austin, the Dallas, the San Antonio, the Tampa, the Orlando, like the Floridas, the Carolinas, like everyone knows like the key marquee markets. But like you mentioned, the insurance right now, in particular in Texas and Florida, is like unbelievable. So I think there's only maybe two insurers left in Florida. So that changes the trajectory. So it's hard to sort of underwrite. One, it's hard to underwrite for the way the interest rates have the trajectory and the rapidity of how interest rates have risen. But two, the insurance rates have been unbelievable in those two places. And then property taxes as well in Texas and Florida, like those are really difficult to anticipate. So I always look really with a fine tooth comb at what the projections are versus the T12, meaning the trailing 12 in terms of what the property was prior to them buying it, in terms of what the expenses are, and then in particular what the insurance and the property tax projections are. Because if I don't see, this is just my numbers, but if I don't see a 10 to 20% increase in that property tax and the insurance rate on those properties, then I don't even want to look. In insurance, I'll probably want to see at least a 20%, but property tax, I want to see at least a 10% increase from deal to deal. And if I don't see that, then I know if I see basically a standalone like property tax and insurance cost of what it was in the prior owner, to me, that's not conservative underwriting, and I'm going to probably look the other way. But there's a number of variables we look at, but those are some of them that's even more important nowadays than it had been maybe 5 to 10 years ago.
Very, very interesting. And that's a total set apart from, I mean, single family. And what I talk about all the time with um like residential versus commercial, I love residential because it's the entry barrier is much smaller. The errors are much smaller. I mean, I miss something on single family, it doesn't hurt me. But think about
Not
the
going to break you.
complexity of it in commercials. Like I didn't just miss it once. I missed it two,
Yeah.
three, four, five. Well, you said 400 units, and there's so much to it. And this idea of a 10% increase or projection for property tax and up to a 20% increase for insurance. I mean, those are massive numbers.
And that's the minimum. I mean,
Yeah.
in reality, I like to see it more than that, but that's the minimum I want to see. And every sponsor that I invest a substantial amount these days in particular in Texas and Florida, I ask them what they're doing to mitigate the insurance risk, what they're doing to mitigate the three things I ask every sponsor about these days, what they're doing in those states in particular, about the first two categories, what they're doing to mitigate the risk of the insurance risk, what they're doing to mitigate the property tax, and how they're justifying their underwriting for that. And then the last thing is, tell me more about the debt. Because now, I mean, the debt is really the biggest risk point of a deal. Like the first thing I look at in a deal is the sponsor and the track record and how many full cycle deals and all those variables that I look at. And then the person, it's got to feel right. They need to feel like they're good people. They know what they're doing. But once I go there, the first thing I look at is the debt structure, because that's going to pose the biggest risk. And that's what we're seeing nowadays, like we talked about with the bridge loans. So that's where that's right where I go when I talk to these sponsors. A lot of the objective data I can get via email, and I don't need to talk to them about it. But for those categories in particular, I want to hear the story and hear how well of a grasp they have on those particular facets of the deal. Because I don't feel like they really are taking into consideration the risk components of that, then that's a deal that I'm probably going to pass on.
And with all of these, I mean, I'm sitting here and I'm listening to you, Sam, and I can tell, man, you've been through some underwriting. You've talked with some partners. You definitely have the experience in the driver's seat in this. So I can appreciate that. And I appreciate that you're sharing this too. And I'm just hearing you say all of these things that I'm picking up about risk and mitigating risk. And I want to come back to that thing that you mentioned before, a sheet. The same way in my life and in my investing career, whether it started out as an Excel that somebody shared with me, and then I've changed it and revised it and manipulated over the years, and it's now into a Google sheet and now maybe into an app or something. It sounds like to me that this sheet that you're mentioning maybe had that same kind of lifespan for you in the multifamily world, right?
Yeah. So basically, initially during that first year, and it's amazing now, it's like 2017 was when I first learned about real estate syndications. And I spent that first year absorbing as much information and knowledge in these other, whether it's books, podcasts, stuff like that. And for me, I always remember better when I then use that information and consolidate it in a space. So whether it's like studying for a test or whether it's, anything that I do when I want to the act of consolidating that information and forcing to put it in a finite space in sort of an organized way, the process of that helps it to sink in with me as opposed to just reading it and then letting it go. So I was really building this sheet in part just for the knowledge edification, but then also when I go through deals early on, I still sort of, fine tune things to this day, but now it's a little more on the tip of my tongue because I've seen a lot of deals. I used that sheet to kind of make sure I wasn't making any heavy mistakes on a deal. So if it met the certain criteria that I had in my sheet, broken down by the main categories, which would be like the sponsor, the market, and the deal, if it met that criteria, I know that even though nothing's foolproof, but at least there's no gross significant red flags when I've come up with criteria that I think is appropriate. So that initially was a sheet for me. And then I'm a part of a number of limited partner networks and groups that I alluded to this sheet and some of the metrics in it. And then the next and sort of brought it up just to kind of, justify as to what my discussions with them were about. And then next thing you know, the next day I received probably like 50 private messages for people asking me to have access to that sheet.
Give me that sheet, Sam. Give me that sheet, man.
I know. So, but it wasn't like ready for prime time. It's not that I wouldn't share it, but I was just like, man, this is like this is stuff that I'm comfortable with, but I don't want to I don't want someone else making a decision based on that. So at that point, you kind of enlisted several partners and kind of came up with that were in the real estate space and we're general partners and we're professional real estate deal bettors, that we then came up with a more sort of organized sheet, which we, and then it sort of formed our website and the whole product at like passiveadvantage.com. And then there, we've now done several iterations of the sheet, and we're actually in the process of not immediately, but over the next couple, probably 6 months or so, we're trying to pivot into a software version to where instead of it being an Excel sheet format, which it is now, we're going to pivot it to like a web-based, software-based format. So that's some really exciting stuff. And we're trying to change. And the beauty of that is that it allows us to be more nimble, to change with the times, to change with the metrics, some of the things we've talked about. If the economic, tides swing a little bit, then we can quickly kind of change. And it's not like we have to send thousands of people new Excel sheets. So yeah, we're really looking forward to that transition as well down the road.
And that's really exciting. I'm seeing these pieces, and I'm glad we got to this. The passiveadvantage.com is where all the listeners could go learn a little bit more about you and also have access to the sheet to Sam Sheet and the newest versions. Man, I'm really excited to see where this product goes for you, and for all of the listeners too, to on the front side, because it feels like in real estate is so far behind in technology. And part of that reason, and this is a personal opinion here, so take it for what it's worth, is data is where the value is at. And the data is kept so closely held, like in the single family world, the National Association of Realtors has like a stranglehold on all of the data. And it's so like you have to jump through so many hoops and do all this crazy stuff to get access to the data. But I'm telling you what, Sam, once you get plugged into that, it's still difficult. The technology of these systems are so far behind. And when you go to plug into something, you got to go back 3 or 4 versions to even get connected. But what's so fascinating, Sam, is the opportunity that's there, the potential that's there. Because as I'm hearing you talk about this software-based platform, I know there's ways that we could integrate this, and I've seen versions of it where you can integrate that same type of stuff to the acquisitions piece. And that acquisitions piece is connected with a CRM system, a client relationship management software. And now we're getting there. Now we're getting there where the technology is caught up. But again, there's always the objective piece, right? That you said that you could get in an email, but then there's the other piece that you have to get through experience, and you have to get through this face-to-face kind of, tell me a little bit about what you got going on, right? And technology is not going to get that.
Never. Yeah. And that's a beauty and a curse, you know? So you're only able to objectify so much. So there's still these kind of things, these kind of tools that we're trying to offer. Because what was happening is, like, I'm a physician at a hospital of 700 other physicians, and people were coming up to me and asking me questions about, you know, how do I get into this? Like, what should I do? Just tell me what to invest in. I'm like, listen, I'm not taking on any responsibility. These are the books that I read. And I, you know, I've read a bunch more, but I felt like those were the most important. Read these books, you know, listen to a couple podcasts, then come back to me and we'll talk. And I was having the same conversation with like 10s and 20 people. And I'm like, you know what, this kind of tool would help people like that to sort of bridge down the education component and get you to the more succinct stuff of what you kind of really need to know, get you to the right data points. You know, we do have an ebook on there that people can download where that's free, that gives you some, you know, as much of that in the book format for people who like to learn it that way. And then we really want to just help people make the space more approachable. Like, I think the biggest step, especially in physicians, I mean, that's the world I'm in, is like taking that first step, because, you know, dropping, you know, 10, 15, 20, 50,000 in some of these cases, it's not an easy move if you really don't know what you're getting into. So we're trying to close that gap to where more people could have access to this, so that down the road, maybe they can kind of, look to achieve some financial independence or cut back on their job or whatever it is they want to do to, you know, diversify income streams.
It's so fascinating too. And I know you, so I'm on the single family side. You're on like the commercial side. It's so fascinating because I'm sure we see the same thing. And especially being out front, doing podcasts and stuff, you get the people looking for the easy button, right? Where's the easy button? You get these tag along investors. Hey, just tell me what to do, where to put my money. And, you know, I felt like, you know, in the beginning, I think it may be human nature to do that. And especially me, I'm a trusting guy. I mean, you get all my trust out front, and it's just tell me what to do. Tell me what to do. Show me what I should do. Where's the easiest part, right? But there's no easy button. There is no easy button at all. But this creates a filter. This creates a filter of the people that are out there making their money make money for them, and the people who aren't, and the people who are looking for that easy button, who are only out here talking, who are not taking action. I hear it a lot, Sam, where, you know, physicians particularly will spend that first year not necessarily analysis paralysis, but just diving in, looking at the deals. Yeah. But that's taking action. It may not seem like it at first, but that's taking action. There is this filter of those people who will look for the easy button, Man, it's such a high percentage too, Sam. I don't know. This is just a guess, but high percentage, like 60, 70, 80% of people, that's all they'll do. They'll run around
Yeah.
their whole life looking for the easy button and never make that step of taking
Never take the
action.
step.
And it's that experience piece that's a game changer. That's, oh, so the free ebook, everybody that's listening to this, go to passiveadvantage.com, download this. I'm sure you're going to have to put your email address in, but that's a perfect thing that I want to talk about here. It's not trying to get anything from you, right? We're trying to get for you, right? And those are the getting past that wall so often in the piece, sharing this knowledge and information with people is, we're not trying to get anything from you. We're trying to get for you, and don't hesitate connecting with the people and putting your name in there. Have mercy. You'd have to say, do not text me if that were any situation before, and have to deal with a marketing thing. But that's how you connect. If you think about the biggest, I guess the most progress I've ever made in my life, Sam, was in masterminds. And those masterminds are going to have marketing around them, right? But think of it. If you don't get past that, go ahead, get away from the cynical perspective of they're trying to get something from me. And this is literally giving stuff away for free. That ebook, there is a very reasonable fee for Sam's easy button sheet in there. So I say go there and get it done and do it. And if the listeners are out here listening to you, Sam, I'm sure they can feel that genuine experience, and you have the results. You talk about full cycle deals and, mitigating risk. It's so remarkable. I just want to thank you for sharing that with everybody.
Yeah, no, it's my pleasure. I'm happy to. That's really the purpose of this. Like, these real estate deals, like I'm happy to do it. I could do it on my own. I'm fine doing my W-2 job. I'm fine doing my own real estate deals, but I really feel passionate about the fact that, what happened was during COVID, and this affected, I'm sure, more specialties than just physicians, but in particular in the physician world, there's a lot of physicians that it was a wake-up call. So some of these guys who were close to retirement, 60, 65, 70, they're like, you know what, I'm not going to deal with it. I'm done. So you have a bunch of those higher age physicians that retired sort of instantaneously. And then you have the physicians in that sort of mid-career range, 10, 5, 10 years out, that were like, you know what, I love my job. I want to keep doing it, but maybe I want to do it 4 days a week, or maybe I want to do it 3 days a week. I'm hearing more and more of those discussions. So part of the passion of that is that I want people to have the opportunity to do that. So if you're able to diversify that 1 day or 2 days to where you're taking an income from these real estate deals where it offsets some of that other W-2 income, or you stay full time, but then maybe you retire in 10 years. So you can kind of work it any way you want. I feel passionate about people having the opportunity to get there, whatever it is, the life they want, to spend more time with their family, to help a loved one. And that's really what we're trying to do. We're trying to get the word out. So we polled those 700 physicians in my hospital as to how many have ever not invested, but have ever heard of real estate syndications. And of those 700, 7 have heard of real estate syndications. So to me, there's like this. I just feel like more and more people, and like I said, I'm more familiar with the physician space, but I'm sure this is in many other fields. More people need to know about real estate syndication, so we're trying to get that word out there and make that investment more approachable for them.
Multiple streams of income is a necessity. It's not a luxury, and I think that's a mindset shift that we need to. No matter what profession you're in, that's how we need to be raised. We need to be conditioned in that way. And there's so much going on out there too. And when I say get over the cynical perspective and, get moving, I also want to put that, with a warning as well too. And just as much passion, we share that passion and sharing our experience and the resources, the team, we share that, Sam. And I'm sure we share this as well too. I'm trying my best to control when I come across it and be temperate, I think is the word, in this. I get so upset when I see other investors doing things that they should not be, and they have physicians or, people tag along looking for easy button, just dragging them along, because that happens, man, that happens. And I get so upset when I see that. And it happens, and it shouldn't, right? There's even right now, the speed of data, the number of resources that are out there, you should have the time and make the time to give your attention to even generate just some reasonable questions, because that is where it starts. We get the seed planted of the curiosity. I get
Yep.
around it. I get around, I go through the cycle a few times, and then you should be able to produce enough experience to have the right questions. But man, tell me, right, you've probably seen this in the commercial world, in syndication especially, where you've got
Yeah.
a GP that has no freaking clue what they're doing, and they should not be doing that. And they've got, hundreds of thousands and millions of dollars along.
Yeah.
And Sam, those times are probably the situations where the GP, the general partner, or somebody in the deal has nothing to lose, right? There's no
Yeah.
skin in the game.
That's right. No, you're totally right. And I think yeah, and you see it in like, the Houston debacle of where, that big multifamily developer and the went under, and basically all these poor people are losing a ton of money in that sort of that model. So, and that's part of the reason why when I look at sponsors to invest with, we look directly at skin in the game, like how much are they putting into this deal? And at minimum, I want to see a matching of the minimum. So if it's a 50,000 minimum, that's the minimum that they should put in, is 50, something like, I don't, and it, outside of the acquisition fee. So I don't want to see it included in the acquisition fee, but that's a minimum. Ideally, I like to see more. But I also like to see that the sponsor's been around for a little while, had X amount of full cycle deals, because it's not that there's part of that I'm looking at the experience ratio, and I want to make sure that they've been there and done that and they've taken a deal full cycle. But it's also that they have something to lose, in that if we hit a time like we're hitting now, where people are having to do capital, sponsors are having to do capital calls, sponsors are having to ask money. If they only have one deal and they've never gone full cycle, they'll say, you know what? If this goes belly up, like I'm gonna come up with another business or do something else, but I'm fine with that. Whereas if somebody bleeds and sleeps the being a multifamily sponsor and syndicator, they're going to say, you know what? This is my life. Like, I want to do this. If I have to, I'm going to come out of pocket with this, or I'm going to get a personal loan from someone else to make this deal work, and not have to taint my name to the limited partners, because this is a career I want to do forever. So someone that's got one deal, like you were saying, or someone that's had 10 deals, that's going to be a different philosophy, because they're not going to want to taint that name, versus someone else that doesn't have the experience. They may be quick to say, you know what, it's not working. I'll call it an experience and I'll go do another career. So that's the other reason, outside of just the experience of the sponsor, I like to see that's kind of sort of a skin in the game without having an actual skin in the game, is that their name's on the line and you can't run from that if something happens.
Yeah, yeah, and the the name is on the line, and I've heard this in other conversations too. When that name does get drugged through the mud, it sticks. That mud is sticky, and
Yeah.
it may seem, I guess, a little overwhelming from the outside, not being on the inside. But on the bigger deals, there's only a certain, there's only a few people who actually do these. So if your name has got mud on it, it's going to stick, and
Yep.
you're going to get other things dirty, for
Yeah.
lack of a better analogy.
And the
Um,
word gets out there quick. I mean, I'm very intertwined in the limited partner space. So we
mhm.
hear these, this in several of these, groups that I'm in, and we hear this stuff all the time. And it's like, once you get that negative connotation about someone, it's very difficult for them to kind of work it around. They really have to come at you with a really desirable deal to want to put money in that deal again. So yeah, it's an interesting time, and I think fortunately or unfortunately, I think there were too many sponsors in the space. There are too many sponsors in the space. I don't think it's supposed to. I think that the ease of making money over the last 5 to 7 years has brought so many sponsors in the space. So I think it's going to, by nature, sort of weed some of that stuff out. So I don't think I think that's a natural cycle that I don't think it's necessarily a bad thing that may come about over the next year or so.
Absolutely. It 100% cyclical on the up. Everything's cool and sexy and in the speed of data. Right now, it's easy to learn and easy to do and the world of social media. It's easy for me to rent a Ferrari and lean on it and take a picture
Yeah,
and say, "Hey,
yeah,
Sam, here's my easy button. You want to join me?" So
yeah.
the cyclical piece, those upsides, it's easy. It's going to be out there. And on the downside, Sam, that's the difference maker. When you're talking about going through cycles, deal cycles, talk about going through market trends, market cycles. And
Yeah.
that really weans people out. And I'm seeing it in single family. I believe it started just about a year ago, and I watched that personally. And now we're down towards the bottom. And not only did money change, market change, but laws changing when it comes to certain things like wholesaling and assigning and stuff like that, and licenses. And what's very interesting is just like in the construction world, in the real estate world, it feels like commercial trags just behind single family. So if
I think you're
single
right.
family hit the low, it started about a year ago. Guess what it feels? Guess what I'm hearing? Like it's the same way that commercial is trending down, and it's going to weed out all these things. And then boom, here comes the end. The bridge loan problems, the interest caps, the interest rises, the taxes, the insurance. Guess who's going to stay on top? The people who don't have mud on their name.
Yeah, you're
Sam,
absolutely right.
Sam, I don't see any mud on your name, man. I just from listening to you, man, it just
I try to
genuine
avoid the
dude.
mud. Maybe not in
Yeah,
real life, but I try to avoid the mud in my investing life because I
yeah,
don't. I'm an anti-drama guy, so I
yeah.
want things. I want to kind of try to do as much due diligence as I can up front because once in the limited partner space, it's different for single family, but in these passive investments, once you give them your money, you have no control, and that's the pro and con that you take. So you have to really, but it's not passive investing. I mean, that's sort of a misnomer, and that upfront is nothing passive at all. We're trying to make these tools and educate and do things that we can to sort of facilitate that process of education. But early on, it's really not passive at all. But once you give that money, there's not much you can do. So you want to try to do your due diligence up front so that you don't have somebody that drags you through the mud with them.
Yeah, I've definitely heard some horror stories as well too, and I just want to echo that too, and that there is no such thing as passive income, right? And nobody's ever going to care more about your money than you do. So picking these paths, expanding your associations to include the people who help you, uh, including going to passiveadvantage.com, downloading the ebook to get that start, looking at the sheet, going to REIs, getting around people that are going to do that, but also disassociating with people too, and moving the people out of your life that are going to limit your growth. Stick around the people who have been through the deal cycles, who have been through the dirt, and even better yet, have been through the market cycles. Those are big pieces. And, and just watch what's going on. Hey, Sam, if you could go back 10 years ago, and we're talking 2013, and you saw Sam, what would you do? What would you say?
And that's a great question. It's interesting because my mentality has always been the decisions I make in life, and I'm sure there's components of everyone does this to a certain extent, but I feel like I really am cognizant of it. That when it's like a not insignificant, like if it's like, what am I going to wear today? That's that. But if it's a not insignificant decision, the way I typically go about that is to look at which approach am I likely to regret less. So I try to minimize regrets in the decisions that I make. Um, and once I make that decision, although there's a lot involved in making those decisions, once I make that decision, I really don't look back. So the mentality is that all the things that I did over the last 10 years or in that period of time, to me, feels like it was meant to happen in the order it was. So I probably wouldn't change anything because I feel like although my student loans were low interest, could I have invested at the time? But there's a mental and emotional feeling of satisfaction when you pay that last student loan bill. Or investing in the stock market. Like there's pros and cons, and everyone's either on one side or the other. But for me, I feel like I do both. Like I'll do the basic stock market stuff. I'll do my pre-tax because obviously it's helping my taxable income, but I also do the real estate stuff on the side. So I wouldn't change any of those things that I've done from a financial standpoint. Personally, I'm blessed to have, a beautiful wife. I have 3 young kids who went to school for the first day yesterday. I was able to kind of take half of the day off, took them to school. So I try to be real intentional about my life. And I think that minimizes regrets. And for me, that's sort of the way that is helpful for me to go about it.
And I absolutely love that answer. It has always been like kind of a trick answer, a trick question, because the same way, if hindsight's always 20/20, they say, but going back, if you were to change anything, then you would change who you are. And, goals to me are more than just things or places or items. It's about who we become. So the fact that going back 10 years would be no different, right? Making those decisions that you would, making the decision that you would regret the least, right? The next best thing. And that next best thing has produced Sam. Has produced Sam in the sheets, man.
And and the reality is, and it's like philosophical, but the reality is there's times in life that we're not ready to get what we think we want.
Oh,
And you just have to kind of understand that and accept that and not try to rush it, but not be slow. So you just kind of, you take it the way it is. You do what you feel is right. You work hard. And I feel like serendipity and good things will happen in life in the time that they're supposed to happen. Like I said, it's partially a philosophical thing that I think from a mental standpoint that keeps me healthier and more satisfied and more thankful for my life. But it's a mentality,
I feel like I could go into a whole nother hour here of the mindset piece. So I want to try to wrap it up with, they're actually lyrics from a song, but go into a faith-based scenario. Some of God's greatest gifts are unanswered prayers. And that's actually a Garth Brooks song.
Garth Brooks
That's
song.
an old one, man. Yeah. But just, man, in life, challenge creates character. Without challenge, there's no change. And the idea of you're exactly where you need to be with who you need to be. We all have this choice of free will, and we all are affected by others' choices as well, too. But if you go in, give it everything you got, and make the next best decision, make that one that you're going to regret the least. And that way you can be just like Sam and look back 10 years and answer that question perfectly. Man, I appreciate your time today, Sam. It's been an absolute blast. Hopefully the listeners have had a great time here. So again, just thank you for your time. And for the listeners, passiveadvantage.com. Go check that out. You get the free ebook and the easy button, right? The sheets are there. Start the curiosity, start the conversations, get around the right people, learn a little bit more about Sam there on that site too. So thanks again, man. Appreciate your time.
Yeah, it's my pleasure, Brett. I really appreciate you having on. If people want to reach out to me directly, they can reach me at sam@passiveadvantage.com, but you can find all the tools and stuff we talked about through the website. But really appreciate you taking the time. It's been great talking, and hopefully we can do it again sometime soon.
Absolutely. Absolutely. It sounds great. And for the listeners out there today, again, thank you for your time. And more importantly, thank you for your attention, because without attention, time is worthless. So thank you for that today. And if you get the chance, drop in to Spotify or Apple, leave us a review so we can get everybody else's attention here too. So we can spread the easy buttons, right? But no, thanks again for your time, and we'll see you in the next one.